Hi everyone, welcome back to my channel. I'm Sharad. I'm a businessman and a mutual fund investor, and on this channel I make videos on personal finance. Today let's talk about mutual funds. In this video, I will explain what mutual funds are, how they function, the advantages of investing in mutual funds, and who mutual funds are suitable for. Now, what is a mutual fund? Investopedia defines a mutual fund as a type of financial instrument which is made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. Let me explain. Mutual fund is run by a company. You can call that company an asset management company or a fund house. This company collects money from various people. Let's say you invest 500 rupees, I invest 1000 rupees, someone else invests 10,000 rupees, and thus the mutual fund ends up collecting a huge corpus which could even run to hundreds or thousands of crores of rupees. Now, based on the amount of money collected from each investor, the fund allots units to all the investors depending on how much money they have invested. Now, what does this fund do with the money collected? This money is invested on our behalf in various assets like equity shares, debt instruments like debentures and bonds, and even gold. To manage these investments, the fund employs dedicated and qualified professionals who are called as fund managers. Needless to say, the goal of the fund manager is to generate maximum possible profits from the money that they have collected. This profit that the fund manager generates is reflected as an increase in the price of the units. So whenever the investors sell those units back to the fund, those units are redeemed. They are redeemed at the price of the units prevailing on that date, and that money is paid back to the investor. For the services that the mutual fund company is providing to the investors, the company charges a fee from the investors, which is called as an expense ratio, which is normally a small percentage of the corpus that the mutual fund company is managing. Now, based on the assets that the fund invests in, if the fund invests in shares of companies, it is called as equity funds. If the fund invests in debt instruments like bonds, debentures, and government securities, it is called as debt fund. And if the fund invests in, say, gold, it is simply called as gold fund. And if the fund invests in various assets like equity and debt together, they are called as hybrid funds. Okay, I tell you, mutual funds are an excellent investment option for individual investors to get exposure to a professionally managed portfolio. I will go to the extent of saying that with regards to investments, you needn't look any further than mutual funds. So much so that all my investments are in mutual funds only. Now, what are the advantages of investing in mutual fund? I can name 5. Diversification, liquidity, professional management, taxation, and regulation. Let me talk about these advantages one by one. First is diversification. We all have heard of the old saying, never put all your eggs in one basket. In investment parlance, this saying can be rephrased as, never invest all your money in one share. It is always advisable to invest in a basket of stocks instead of 1 or 2 stocks. But suppose you have, say, only 1000 rupees to invest. Which stock will you invest in? All the good quality stocks trade in thousands of rupees nowadays. Reliance is trading around 2000 rupees. TCS, the biggest IT company in India, is above 3000, and HDFC Bank is above 1500. Even if you have 5000 rupees with you, you will not be able to own these 3 stocks together. But on the other hand, if you invest a meager amount of, say, 500 rupees in a mutual fund, you will be able to get an exposure to more than 30 good quality stocks. So that is the biggest advantage of investing in a mutual fund, that even with a small amount of money, you get to own a portfolio of good quality and professionally managed stocks. The second one is liquidity. Liquidity generally refers to how easily and quickly an asset can be bought or sold. Now, based on the way they are bought and sold, mutual funds can be classified as close-ended funds and open-ended funds. Close-ended funds are for a fixed tenure, wherein you invest for a fixed tenure like 3 years or 4 years or sometimes even 10 years. But unlike the close-ended funds, open-ended funds can be bought and sold on any working day. Now, I don't like close-ended funds at all, but I'm a big fan of open-ended funds. Why so? Maybe I will explain it in another video. So these open-ended funds can be bought and sold on any working day. Suppose you have invested in an open-ended fund and you find that the fund is not performing as expected. You can always redeem the units of the fund and invest in a better performing fund. Also, if you require some money for some expense, you can very well sell the units to the extent of the money required. So this liquidity that the mutual fund offers is a big advantage. The third advantage is professional management. By professional management, I mean that your money is being managed by dedicated and qualified professional fund managers. They are better equipped to manage the money than us. Now just imagine a situation, there were no mutual funds around. Now what would you do if you wanted to own a portfolio of stocks? You would have to invest in shares all by yourself. And mind you, selecting good shares to invest is a tedious and time-consuming job. And not everyone is cut out for that. Okay? Even I myself feel that selecting and tracking stocks is a time-consuming process. So I prefer handing over my money to the mutual fund manager and focus my time and energy on my own business, where I can make more money for myself. Now, you could be a doctor or a lawyer, or you could be a IT professional. What would you rather do? Would you rather devote your time in becoming a better professional in your field, or would you spend a considerable amount of time and energy in selecting good stocks to invest your money in? Think about it. You should focus on your field of work, right? That's what mutual funds helps you to do. You hand over your money to the mutual fund where your money is professionally managed and you focus on your profession or business to make money. The fourth advantage of mutual fund is taxation. I consider this as the biggest advantage of investing in mutual funds. Now, I am speaking with regards to tax laws in India. Things could be different in other countries. Now, within this taxation, you derive two distinct advantages. The first advantage is that you are taxed only when you sell the units of the fund. I must say that this is one of the big advantages. Now, let me explain how. Suppose instead of investing in mutual funds, you are investing in shares directly. What happens is each time you sell the shares, you are subjected to capital gains tax. So the more you keep buying and selling, the more tax you keep paying to the government. But on the other hand, if you invest in a mutual fund, the fund manager will keep buying and selling shares on your behalf. But each time the fund manager sells the shares, the mutual fund is not subjected to any tax. Okay? Because government treats mutual fund as a pass-through vehicle. It is only when you sell your units of the fund that you will be subjected to tax. This is one big advantage with mutual fund. Now, the second advantage with regards to taxation is that the profits that you derive from a fund is subjected to a concessional tax treatment. You could be an employee in a company, or you could be a professional or a businessman. Okay? You are working hard in your respective field to earn your income. Now, this income is subjected to tax depending on your tax slab. For people like me, we pay 30% tax plus surcharge. But on the other hand, if you invest in an equity mutual fund and if you stay invested for more than a year, whatever profits that the equity fund generates for you, it could even say run in crores. These gains are subjected to a flat rate of 10% tax only. Just 10%. The money that you are earning through your work is being taxed at 30%. But the money that your equity fund is earning for you is being subjected to only 10% tax. And that too not on yearly basis, but only at the time when you sell your mutual fund units. So literally, you can hold on to your mutual funds till your retirement, which could be 30-35 years away, and you needn't pay any tax on that till such time. I find this concessional tax treatment of a mutual fund as a compelling reason to invest in them. Whatever income that I generate from my business, I pay tax at the maximum rate. and the remaining money that I'm left with, I invest in a mutual fund and I allow it to grow. I'm not required to pay any taxes on this growing amount till I sell those mutual fund units. This is how serious wealth is created over long term. The fifth point is that the mutual fund industry in India is highly regulated. Securities and Exchange Board of India, in short SEBI, is doing a good job in regulating the mutual fund industry. So it is safe to assume that your money in mutual funds is in safe hands. Now the mutual fund investment could suffer a loss, but the chances of you getting defrauded by the mutual fund company is very, very low. Now finally, who all can invest in a mutual fund? The answer is pretty simple. I say that each and every one in this world should invest in mutual funds. Even an investment should be made for a newborn baby for its future use. Mutual funds are various products to cater to various requirements of people. I shall talk more about the mutual funds in future videos. So do subscribe to my channel, leave comments with video requests you have, press the bell button to turn on the video notifications, and I'll see you in the next video. Bye.